What's up guys, Jake here, welcome back to the channel. We're going to do an update video for my Schwab 25K brokerage account challenge. In the event you haven't seen any of my prior videos, I will include the playlist down below so you can catch up. And it's me versus a total stock market index fund. My goal is to double my $25,000 initial investment this year, January 1st through December 31st. At the very least, I have to outperform that total stock market index fund, otherwise I just wasted my time. And this video is current as of my positions on February 22nd. This is day 34 of 252 trading days, and the S&P is kind of in a slump. It's gone below 3,900. I think stimulus will be passed in the next 3 weeks through the budget reconciliation process. So I think there's a lot of people waiting to buy until that news is confirmed that it's going to happen, and then the market will probably pop above 4,000 for the S&P. So the total stock market index fund is down a little bit since my last video. It's still up 6.16% on the year. However, I am up 9.05%. So I'm up $2,262 on my initial investment. These are my positions as of my last update video if you want to compare, and it has changed to this. First, let's go over what I sold for a profit in the last couple days. And the first position was Synchrony, and I'm pretty proud of this because this was my largest position ever, over $4,000. And I got a profit locked in of $251 or 6.2%. When you look at the stock chart, once again, a recap, I bought down here when it was approaching the 50-day moving average line. It's recovered nicely. It still isn't back at all-time highs, but I just wanted to free up this cash to get into other positions potentially. Next up is the Interpublic Group, IPG, cost basis 2011. I locked in a $136 profit, 6.8%. And looking at the stock chart, if you remember, they reported their earnings on this day, and there was a huge sell-off. Once again, their earnings report was good. They beat projections, expectations. So I just jumped into the stock. It took a week, less than a week for it to recover, and it's back at all-time highs. And then finally is Xerox, and this had a covered call on it. I had sold a covered call on Xerox, and I was assigned. And I've actually never had this happen before. I've always closed out the contract, but I wanted to see it actually happen. So in your brokerage account, it looks different obviously for other platforms, but in Schwab, this is, if you go to account history, this is what it says. It actually says assigned. The covered call expired on February 19th, and I was assigned, so I had my 100 shares taken away from me, and I was paid the strike price of $23 per share. Obviously, there's like a 5 cent commission on that trade, so I got $2,299.95. And Xerox at this time was above $23. So the person who bought the call contract is happy because they got more value than what they paid, hopefully. And I'm happy because I wanted to get rid of this stock. My cost basis was $2,210. I deliberately sold a covered call in the event that I lost my stock, that I would be, above my cost basis. So I still made 89 bucks for a return of 4.1%. And as far as taking profit, we can now count the contracts that expired out of the money. So I had 2 put contracts with Synchrony Financial and Citizens Financial Group, and then the covered call with Xerox. So I made money on those positions. So let's go through these first. The covered call, my premium was $38.35. I always was going to be able to keep that. Same thing with the put contracts I sold that expired out of the money. I wasn't forced to buy 100 shares from somebody else. So I'm positive 282 bucks on trading options, so far this year, and I think that's pretty good. I'm going to keep going, try and stay positive. And then these are all the positions that I've bought and sold for a profit. So on my ordinary positions, swing trading, I've locked in over $1,800 worth of profit this year. And going forward with this challenge, I'm actually going to probably start buying and selling options more frequently. And I wanted to resist this when I started this challenge 2 months ago, but the more that I think about my money being tied up in stocks that just trade sideways, it's pretty frustrating. You can cover a lot more ground by buying call options as opposed to buying the stock. Now, I didn't feel comfortable 2 months ago because I knew the broad strokes, but I didn't get into the nitty-gritty details. So once again, if a stock is going up and I only want to deal with stocks that are in uptrend, you can buy it, you can buy a call, or you can sell a put. But when do you do which one? That was the piece of information that I was missing. When do you know to buy and when do you know to sell in a stock that's doing the exact same thing? If you want the deeper understanding of trading options, I highly recommend watching my Greeks video where I break down all the Greeks in detail. It's a 28-minute video, so you got to be pretty committed to get through it. But what I learned in this video while making it is theta decay is so egregious to me that I'm never going to hold a contract that I bought in the last 30 days, probably the last 60 days. So the sweet spot when buying call or buying put options is to trade in this 120 to 60 day range. You're still losing a little bit to theta over time, but it's not a majority of the contract as you get down to the final days. So the sweet spot when I'm buying call options, I don't plan on buying put options because that would be for downtrending stocks. But for buying calls, I'm going to be buying in this 60 day to 100 day, 120 day range. And by 60 days, if it's not positive, I just want to get rid of it. I don't want to mess around with that call option anymore. If it's not positive by 60 days out, I don't see my odds improving as theta decay wastes away the contract. And then the most important Greek that people don't pay attention to is Vega. Vega is tied to implied volatility. As a stock jumps around, basically, implied volatility of the contracts will increase. And it's a percentage between like 1 and 99. And Vega measures how much the contract will move for every 1% change in implied volatility. If you just look at the Greeks, you can follow along basically how much the contract will increase in value or decrease in value if a stock jumps around. So think about it. If a stock starts the day at $50, shoots up to 55, goes down to 45, then returns to 50 by the end of the day, should a option premium be the same at the end of the day? No, the stock is wildly jumping around, so implied volatility went up, the contract premium went up. And implied volatility and Vega is good for buyers. After you bought a call contract, you want to see the market get wild because the premium of your contract will shoot up. And you can then just get rid of it. It's not worth holding on to when implied volatility has spiked like that. And the opposite is true for selling. Once you've sold a contract, you want the markets to calm down. You want implied volatility to decrease because then the value of the contract will decrease. So if you want to buy it back to close it out, it doesn't. You can take profit. So here's the game plan with trading option guys. I think this is something that a lot of people want to know and a lot of people are missing. So if you only want to trade uptrending stocks, which is my game plan for this series, if implied volatility is high, then sell a put. Then buy to close if IV goes down. So what number for IV is high? Anything over 40 is pretty high. The sweet spot for IV being low is in the 20s or less. Once you're in the 30s, it's basically not really high, not really low. Anything above 40 is pretty high. So if IV on a contract or a stock is high, sell a put and then buy to close once the markets calm down. IV calms down. However, if IV implied volatility is low, then buy a call. Because the markets are calm and the stock price hasn't been skipping around as much, there's a greater chance, in the next 3 or 4 months that the stock market will get crazy. And when the stock market gets crazy, the premium contract, it doesn't even matter if the price is in the money or out of the money. Extrinsic value at this point will skyrocket for the premium of the contract. So just sell to close it. If implied volatility goes up for any call contract that I bought, I'm just going to exit the position. I don't care which way the stock is moving. I don't care if it's in the money yet. If I can capture that extrinsic value from Vega increases, then it's worth selling to close, waiting for the market to calm down. And if I really want that call contract back, I'll just buy it back. So the first call contract I bought is Verizon. If you watched my last video, you know I'm bullish on Verizon. Warren Buffett picked it up. It hasn't rebounded back above its 200-day, 100-day moving average yet. This is a defensive stock. It's a dividend stock. So I think if there's a drop in the market overall, this is a stock that people flee to when all the other gainers aren't gaining as much. So I think it's cyclical. It'll come back in the next couple months. So I chose an expiration date of June 18th, strike price $57.50. So to be in the money, it's only got to go up to basically here, where the current 50-day moving average is. However, I paid $175 for the premium of this contract, so my break-even share price is $59.26. Can it get above $59.26 in the next couple months? I think so, but if it just spikes up at any point, I still have extrinsic value being 4 months out. So if I can sell this call contract for a 100% profit and basically double up my money, then I'm happy to get rid of it. Next call contract that I bought is a new company, and this is Hartford Financial Services. It's an investment and insurance company. It's doing pretty good, but the share price has not returned to its pre-pandemic levels when it was trading close to 60. So I chose an expiration date of June 18th. The strike price is $55, so it needs to, and my cost basis was $185.65. So my break-even price is $56.86. Can it get above $56.86 in the next couple months? I think so. I think that we had our Golden Cross event where the 50-day crossed above the 200-day. It's now in an uptrend. I mean, just looking at their fundamentals, I mean, the PE is 10.72. Anything under 20 is good. Forward PE 8.32. Once again, under 15 or under 20 is good. Price to free cash flow. I don't think I've mentioned this yet, but free cash flow is basically how much money they have to pay their dividends, do stock buybacks, and reinvest in the company. So you want this to be a lower number, ideally once again below 20, and their price to free cash flow is 5.67. Debt to equity, obviously you want this ratio under 1, it's 0.25, so this company is looking great. Something I always check too is if they're doing stock buybacks. They're not really. It's red down here a little bit, so they're doing a little bit of stock buybacks, but the important thing is they're not issuing new shares. You don't want to hop in a stock where they're massively issuing shares to basically stay afloat. The next call contract I bought is on Aflac, and once again, Aflac is an insurance company, and once again has not returned to its pre-pandemic share price. I think it peaked at 55 in 2019 and then fell off a cliff. I think in general for insurance companies, people are pretty nervous, what with everything crazy going on in the world, of getting back into these stocks, but we've already gotten 4 quarters almost worth of information and they're doing pretty good. Aflac is at an all-time high. However, I checked the IV on the stock and it was I think in the low 30s. So I felt comfortable jumping in, even though once again, it's at an all-time high. I chose an expiration date of May 21st, strike price of 50. So my cost basis was $195.65. It just has to get above $51.96 to be in the money. I mean, it's at $49.21. So I felt like this was a pretty good deal on this contract. Aflac's fundamentals, PE 7.36, forward PE 9.5, price to free cash flow 6.9, really good. I mean, once again, anything under 20 is great. Something you can also look at is profit margin. Anything above 10% for a company is pretty solid. It implies that they can grow faster. The smaller the profit margin, the less they're earning on their services, and the less they can reinvest in the company unless they scale up huge. Checking how many shares outstanding, and wow, look at Aflac go. They were not joking around with their stock buybacks even during the pandemic. So whatever their game plan has been since 2014, they're sticking with it to make sure their share price goes up. Last couple of things we should talk about is Apple. All the FANG stocks are not doing well right now as people are rotating out of the companies that were overbought last year and they're trying to find value in other places. So my position in Apple is down 6.7% and Apple is down 12% from their high. Once again, yes, all the FANG stocks were overbought, but I just don't see Apple, going much lower than it currently is. So look at how Apple has bounced off its 100-day moving average twice in the last 4 or 5 months. It reached it here, bounced off, reached it here, bounced off. It almost hit it today, and I was watching it. So I think if Apple is negative again tomorrow, then I will double up my position. I only have $2,000 in Apple, but I will happily dollar cost average or reduce my cost basis down, go to $4,000, and then once again, but Apple's not going to crash. What's going to happen with Apple is it's going to start consolidating sideways within a range, and if you're trapped negative in a position, you just have to time it when it's at the bottom of that range, and then try and get out of it for a profit once you're at the high point of that range. And that's basically what I'm doing with Costco. Costco, we've been watching the last couple update videos, and it's slowly reaching that 200-day moving average. Once again, Costco was overbought last year. You look at the fundamentals, yeah, it's a rich price. So it's been in a downward trend, and I was waiting for it to hit 350. It bounced off 350 previously, and it didn't go below 350. If it went below 350, that might be a problem for me. But once again, this 200-day moving average creeping up. I doubled up my position in Costco. So if we look at it, I was down over 5%. I'm now only down negative 0.29. So I feel like it's easier for me to get back above my cost basis and exit this position if I need to. So a recap, what am I looking for with Costco? Maybe just positive 1%, 2%, 3%. Verizon, it's not popping in the near future like I'm hoping it would based on the Warren Buffett buy, but still looking for 5%. AT&T, I really should have sold this by now, guys, but I'm getting greedy because I also have the put and the call on it. CVS Pharmacy, still looking for 5%. Johnson & Johnson, still waiting for that announcement of emergency use by the FDA for their vaccine. Apple, let's see what it does tomorrow. I might double up my position. And then Walmart and FMC, still looking for 5%. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. I feel like there's a lot of information in these videos that I'm just trying to pack in there for you guys. If you ever have any comments or questions, let me know down below. I'll help you if I can. Till the next video, take care.